Welcome to the deep dive. Today, we're trying to cut through, all that daily market noise. We want to give you the essential insights from the latest reports, the earnings, the economic data. Basically, our mission is to unpack what's really driving things right now. Okay, so let's try and unpack this. The S&P 500, it's seen some slight recent wobbles, down about 0.37% in one day, 0.77% over the last week. But if you zoom out, the longer-term picture is actually really quite strong, up over 2% last month, a huge 14.66% over 3 months, and, well, nearly 13% over the past year. Solid numbers.
That's right. And despite that, strong longer trend, those recent dips, the daily and weekly ones, they show a market that's really actively digesting a lot of conflicting signals. It makes a pretty good time to really dig into what's behind these moves, understand the details behind the numbers, especially since we're seeing some, well, interesting shifts in how investors are behaving.
Okay, so let's start right there with immediate reaction on August 1st. We saw the Dow, the S&P 500, the NASDAQ, they all slid, ended the month on, what some called a sour note. And this slide seemed heavily influenced by that looming Trump tariff deadline and everyone waiting for the big jobs report. But here's the really interesting part, the paradox. This slide happened even while Wall Street was looking at genuinely positive news. Things like a tariff reprieve for Mexico, a new trade deal with South Korea, and, really strong innings from Meta and Microsoft.
It is fascinating, isn't it, how quickly the market seems to prioritize fear or maybe anticipation over concrete good news right now. It's not just a paradox. I think it reveals a market grappling with some deep uncertainty. So on one hand, you have those clear wins, trade deals, fantastic earnings. But on the other, the fear of what's coming, tariffs, that jobs data, it holds more immediate sway. And that jobs report, it's seen as a really big market catalyst, especially, like you said, with that hawkish Federal Reserve tone still hanging around and that hotter PCE print we got. That's the inflation measure the Fed watches closely. Both of those things are shaping what people expect for future interest rate cuts. Carol Schleif over at Bopolev Private Wealth, she emphasized just how critical labor market data is for the Fed's decisions and for how the markets react. It's huge.
Right. And this whole immediate reaction, full of these mixed signals, it kind of leads us to a bigger, maybe longer term thing. The market's relationship with the Fed. There's this old saying, almost like a rule on Wall Street, don't fight the Fed. The idea that you just can't win against monetary policy. But that idea, well, it seems to be losing some steam lately. Federal Reserve Chair Jerome Powell, he's kept that cautious stance, right? No rate changes now for the fifth meeting in a row.
Exactly. And it raises this really important question. What makes this particular bull run different? Why can it seemingly defy that old saying? Jim Paulson, he's a veteran strategist, he pointed out some data showing that this current bull market, the one that started back in late 2020, was actually first in 60 years, 6 decades, to power through hawkish Fed policies in an unfavorable economy. It's kind of an anomaly.
Okay, so let's zoom in a bit from those big market forces. How are individual companies playing into this, or maybe defying the trends? We saw NVIDIA hit a record intraday high, $183.30. And that surge was pretty clearly tied to Microsoft and Meta's blowout earnings. It reinforced that idea that companies are going to keep pouring money into AI chips. Although it's worth noting, NVIDIA didn't actually manage to close above $180 that day, so bit of a fade.
And if we connect that back to the bigger picture, we're seeing a pattern Jonathan Krinsky pointed out, this post-earnings pop getting sold off pretty quickly. I mean, even with those stellar results from, two massive mega caps like Meta and Microsoft, the NASDAQ itself was still down compared to where it opened. It really shows how quickly people are taking profits off the table, even when the news is good. Suggests maybe a cautious mindset, right?
Yeah, definitely cautious. And that quick profit taking, it highlights how uneven the market strength is. So while Microsoft and Meta were strong enough to basically keep the S&P 500 afloat, more than 2/3 of the companies in the index were actually falling. The whole index was kind of bouncing in and out of the red. And this unevenness, it's not just within the S&P 500. You see it when you look at different sectors, too.
For sure. Like, while those tech giants showed resilience, you look at Coinbase, impressive 54% gain year to date, huge market value, right? But they actually missed on revenue.
Yeah.
So even booming areas aren't totally immune. And then look at traditional energy, ExxonMobil. Shares basically flat since late 2022. Earnings expected to be down quite a bit, even with a pro-energy administration. But then you contrast that with Chevron. They're getting positive momentum. They closed the Hess deal, got permission to restart in Venezuela. So a clear split, even within the same industry.
So wrapping this up, what does this all mean for you, the listener, trying to make sense of it? We've got a market navigating a really complex environment. You've got tariffs looming, that key jobs data everyone's waiting for, a Fed that's holding firm, and this really mixed bag of corporate earnings. It feels like a market showing both, I don't know, fragility underneath, but also some surprising resilience in spots.
Yeah. And maybe the final thought to leave you with is this. Given the obvious strength we see in some individual companies, especially those big tech names and some genuinely positive news like trade deals, why do these broader anxieties about inflation, about tariffs, seem to have such a strong grip? Why does it lead to such quick profit-taking and all this daily volatility? What does that tell us about the current investor mindset, and how might that shape things going forward? Definitely something to keep mulling over.